Hello, chart watchers, and welcome to this Wednesday, November 21st Market Watchers Live Show with your hosts, Tom Bowley and Aaron Swinland. For those of you joining us for the first time today, welcome to the show. And for our regulars, welcome back. Well, we got a little different picture in the market today. Currently, we have the Dow Jones Industrial Average up 150 points, the S&P 500 up 25, the NASDAQ up 100, and the Russell 2000 up a little more than 27 points. 10-year Treasury yield also on the rise, meaning that we are seeing money coming back out of the Treasury market. We've got the yield up nearly 4 basis points, 3.09%. Volatility index, which hit a high in November yesterday, is back down about 7% today, back down just below 21. Energy getting a lift today. Crude oil prices last check up about 4%, and you can see that the XLE rallying pretty strongly. A lot of technical damage done, though. We'll see if we can get through some key levels. Also performing well today, we've got communication services, and a big reason there is we've got a nice bounce going on in the internet stocks. To the downside, as you might expect, some of the defensive areas. Utilities yesterday had a false breakout trying to get above a double top from October and November. We did fail to do so, finished with a reversing dark cloud cover candle. I would have expected some short-term weakness. We're seeing it today with utilities. Staples continuing its recent downtrend, down about 0.5% today. One stock doing very well in the S&P 500 is Autodesk. Autodesk reported some pretty strong results. Gapped up, went almost up to 140, but has come back down about $6 off its earlier high, still up about $11 on the session. All right, Aaron, it is Thanksgiving, almost one day away. Want to wish everybody happy Thanksgiving. And I'm assuming you're probably getting together with your parents, correct?
You would be correct. I have one of my two daughters who will be joining us tomorrow, so that'll be nice. Don't see her very much, even though she does live nearby. I think when they hit a certain age, you just never see them again. It just seems like the way it is. Yeah, somebody told me that if we've got Friday is Black Friday, let's see, Saturday is Small Business Saturday, and I think today they call it Apocalypse Wednesday at the grocery store. So,
wow. Well, I'm calling tomorrow. Some people are calling it Thanksgiving. I'm calling it Redskins Thursday.
Ah, well, for your sake, I hope that it is a good Redskins Thursday.
Yeah, I'm afraid to watch, as usual. But anyway, we do have Greg Schnell with us today. Special guest, Greg. Always great to have you on the show. How are you doing today?
Hey, thanks, Erin and Tom, for the invite. Yeah, we'll have lots of fun today. I've got my usual selection of charts that'll be a little different in profile than what you guys usually get from Tom and Erin. So hopefully there's some ideas in there. So we look forward to that.
Well, anything different than what Tom and Aaron are giving you probably is a good thing, right, Aaron?
Oh, yes. Well, I don't know about me, but...
Oh, okay. Sorry. I didn't mean to throw you in under the bus with me. Well, I know, Greg, you're operating from your southern home right now, aren't you?
I am hanging out in Scottsdale for a couple of weeks. Yeah, so it's a lot better than the shoveling at home. And I've been sending everybody pictures of golf courses, and they're sending back pictures of snow shovels, and yeah, so we're having a good messaging war. So it's nice.
Yeah, I'm gonna think that probably Thanksgiving week in Scottsdale's got to be a little bit better than Thanksgiving week in Calgary.
Yeah, there's nobody hitting a golf ball at home. That's for sure.
I'm sure. All right. Well, I know you got some interesting stuff. Hang around with us, and we'll bring you back in about 15 minutes or so. I know you got a great presentation. Everyone will certainly enjoy that. So stick around, please. And Aaron, why don't we just take it away?
All right, let's get it going. Obviously, no market watchers tomorrow or Friday. I do believe the market is open for half a day Friday, but we are taking it off. Tom, you have a workshop on Tuesday coming up. Wednesday, Mark Chaikin is going to join us. That'll be a great show. So I'm very much looking forward to next week. And also just a little teaser, Cyber Monday is coming up. And I know that Chip has put together a really good special. So keep an eye out for that. All right, today's agenda. Well, we do have Greg here talking about a golden setup. Curious. 10 and 10 to 1. Our first symbol is going to be Abbott Laboratories, ABT. And then we're going to finish off the show with the three of us talking about relative strength. So should be an interesting show. Stick around for the whole thing. Tom, let's go ahead and get it started with the technical news and headlines.
Yeah, there was a ton of economic reports out, and you'll find that on your screen in 1 second. But October durable goods came in very weak today, minus 4.4%. Market was expecting a weak report, minus 2.5%, but still 4.4 is a pretty big drop there. If we strip out the transports, October durable goods actually rose 0.1%, but again, falling short of expectations, which we're looking for a rise of 0.4%. Then we had initial jobless claims coming out at 8:30 as well, and they came in higher than expected, 224,000 versus 215,000. And then at 10 a.m., we had another slew of reports come in. November consumer sentiment missed expectations, 97.5 versus 98.3. October existing home sales came in a little better than expected, 5,222,000 versus 5,210,000 units. And then October leading indicators matched expectations with a rise of 0.1%. So what does all that mean? Well, bond market kind of liked it. Well, bond market kind of didn't like it because they sold off, but the yield was rising, which typically coincides with some pretty positive action in equities. And that's what we're seeing so far today. You can see the overall uptrend in play. Talked about this downtrend that we've been in the 10-year Treasury yield, really hoping that we would hold no lower than, say, this 3.01% area, where we had a triple top breakout back in September. Didn't quite get all the way down there, which was a good thing. I think we got down to 304, maybe 303 and change yesterday, and bouncing back up. So got some overhead resistance now to deal with. We do have a death cross there with the 20-day coming down below the 50-day moving average, so we'll need to try to get through that. But for now, I'm just looking at this as sideways consolidation. All right, we had a number of earnings reports out as well, so let's take a look at those. We had Autodesk. This was one of the better reports out there, at least in terms of market reaction. The Autodesk came in 29 cents versus 26 cents. All right, I got the wrong screen on here. I'm not sure what's going on there, but we had Autodesk up 29 versus 26. Copart beat. Keysight Technologies also beat. Gap beat 69 versus 68 cents. And then Deere and Company was really the laggard. This was the one that kind of threw the market this morning, 230 versus 244. That was not a very good report, obviously, but they also missed on their top line. Deere came in $8.34 billion versus $8.59 billion. So that was a pretty sizable miss on their revenues, in addition to missing on the bottom line. So let's take a look at a couple of these charts here and see what's going on technically. First with Autodesk. Here was the gap up. One of the problems was we got up to the 50-day moving average. We got pretty close to that earlier November high, and then the selling kicked in and came back down. So I think this 140, 141 area is going to be really important. We did go down, put in a lower close yesterday with a much higher PPO. So we have a positive divergence here with Autodesk, and that could be, helping to lead to a 50-day test. But the big question for me technically is, can we get through? Because if you look back over the last 6 months, Autodesk has, for the most part, just been sideways. We did have the big gap up back in August. We had the big drop at the end of October with the overall market. And now we're sitting in the middle. So I'm not sure which way this goes, but a break above 140, 141 would be a short-term positive for Autodesk. CPRT, this is Copart, reported yesterday. They did beat slightly on the top line, slightly on the bottom line, but the overall downtrend and sideways consolidation remains intact. So despite the gap up and the nice 5% gain, I think there's still a lot of work to do here on the CPRT chart. KEYS, this is Keysight Technologies. And this particular stock, you can see also gapping up, but struggling to get through the 20-day moving average. Beat on the top line, $1.05 billion versus $1.02 billion. Beat on the bottom line, but you can see technically still struggling, even with a positive divergence. Lower close, higher PPO. A break through the 20 would likely signal a move back up to 61 to test the earlier high in November and that declining 50-day moving average. But if we can't get through the 20, then looks like maybe another pushback to the downside. All right, how about Gap? GPS Really nice move up off of the low yesterday. And after gapping higher, it's continued pushing higher, which is a little different than what we've seen on these other charts that we were just taking a look at. So gap has continued to move higher, but I think technically we got a lot of issues here. We had seen some strength. We had a positive divergence, lower price, higher PPO. We made that run all the way back up to the 50-day and right back to the center line on the PPO, and then reversed. And that selling started with a bearish engulfing candle back at the end of October, went down. I think this is probably just a temporary move back to the upside. I'd watch that 20-day moving average. I think that could be where we run out of some steam. Let's take a look at Deere. Deere is the one that came up with a really bad report, missed on the top line, missed on the bottom line, gap down, but we have seen some recovery in the stock and actually up about 4%. I still think the overall trend here is lower, though. I doubt that we're going to get through that 148, 150 area. If we could, obviously that would be a very bullish development. But if this were a stock that I had to trade on one side or the other, I think I would be shorting it into this strength up around the 146, 148 area and keeping a fairly tight stop around that 150 level. All right, let's take a look at a couple of the indices, because when we look at the daily charts, and I'm going to start with the Dow, we came back down and essentially put in equal lows with a much higher PPO. The positive divergence, though, I think is stronger as we go through some of these other indices. The S&P also almost the exact same low. I think we were within 1 point of that low back in late October. Technically, it's not a positive divergence because we didn't close below. But, I mean, we're talking, a couple of whiskers here, less than 1 point, like I said, between these two closes. So essentially even closes with a much higher PPO. We could see some additional strength here, and we'll talk about the 60-minute chart in just a second. Let's pull up the NASDAQ. The NASDAQ definitely has a positive divergence in play, and we are starting to see some relative strength in the NASDAQ. But here was the move lower, clearly a much lower close and a much higher PPO. So I think in the short term, if we can get through some short-term resistance, which I'll talk about again on the hourly chart in just a second, then we might be out of the woods, at least in the near term. Russell 2000, this is the only thing that I'm trading right now. I talked about this yesterday. We went down, hit this support area, and I could stretch this out, and you will see that this is a really big area of support on small caps. I'm going to go back even 2 years so that you can see the February sell-off that we had back here. We obviously had we were moving higher, all-time high territory on the Russell 2000. The February high volatility swoon came in. We went all the way back down, basically hit this 1450 area, which was our breakout in September 2017, kept rising. And with all the selling we saw in October and again here in November, right back down to around this 1450, 1460 area. I think today or yesterday's low was down in the 1460s. And I talked about it getting close to the October lows and how the setup wasn't bad, especially from a reward to risk. I'm not saying that this index looks healthy. We obviously have broken down, tremendous volatility. I think there's a lot of risk out there, but it was at a key support level, so you could keep your stops very tight. So right now, I think the Russell 2000 has a chance to continue higher. One thing I'm watching, though, are on these hourly charts. We did get a confirmed break above the 20-hour on the Russell 2000. We're seeing outperformance on the Russell 2000, which I think is important. I'll show you a relative chart on that in just a sec. But you can see right now we are above that hourly, that 20-hour EMA. And as long as we stay above that, then I think we've got a nice little uptrend in play here on the Russell 2000, coming off of what I had mentioned was pretty significant support. So let's take a look at the S&P 500 hourly chart. Well, we had gap support just above 2680. We tested that twice, gap down below it. As we come back up, we haven't even gotten that 20-hour test yet, and we do have overhead resistance at 2680. So short term, we got some obstacles still left on the S&P 500. Let's take a look at the NASDAQ. NASDAQ went up, hit gap resistance, hit the 20-hour EMA, and so far backing off of it. If we start to accelerate to the downside, clearly that would be a bad signal for the NASDAQ. But what I'd be looking for is to see, because we had the gap down, maybe short term, this is an exhaustive gap. As I pointed out earlier, there is a positive divergence on the daily chart. So I think if we break back up above this 20-hour EMA, that would be somewhat significant. Last thing I want to leave you with here is that on a relative basis, the Russell 2000 relative to the benchmark S&P 500 has come down into this area probably about 4 or 5 different times over the last 2 years. And this is where we have seen the Russell outperform. So I think this is another reason to consider the Russell 2000 if you are taking a shot on a rally here. All right, Erin, I know you got a number of upgrades, downgrades. What you got for us?
All right. Yeah, actually, it was kind of a quiet day as far as upgrades and downgrades go, but there were a few interesting ones. So let's go ahead and take a peek here. All right, so I'm going to start with the upgrades. JP Morgan upgraded Southern Copper Corp. I know it's not necessarily a huge volume all the time, but I thought it was interesting just to see that copper itself, that metal, was being upgraded today. This is the weekly chart of Southern Copper. And you know what I noticed, there are 2 distinct levels of support/resistance. And I would call the 3750 was very important. That matched up with these 2 tops back in 2017 and 2013. And we broke down below that. And I really don't see $35 as a strong area of support right now. You know, maybe on the upgrade, we'll see something come off of that. But honestly, I think we still have a little bit more work to do to the downside just to get down to that $31, $32 level. You can see the PMO is getting oversold, so it really is that time. It is time for it to make a turn, and we'll be watching that. Tandem Diabetes Care was upgraded today by Robert Baird from a neutral to an outperform. And I pulled up a daily chart here. This one I did put in log scale because otherwise you couldn't see anything that was going on earlier in the year. So the important thing I wanted to point out on this upgrade is this bounce off of the 200-day EMA. I think that's very important. It's held. Today we're moving to the upside. You know, that breakdown to go down and test that 200-day EMA dropped it below the 50-day EMA. So if I'd looked at this yesterday, I'd have probably had a lot more heartburn with it. But seeing that it hit that 200-day EMA and is bouncing is a good thing. And you can see in the thumbnail, at least, that the PMO is trying to, that it's been yanked up on today's almost 17.5% move to the upside. So it would be a bit of a chase, I guess, at this point if you were to get in. All right, a couple of downgrades for you. Let's start with Ecolab. This one was downgraded today by Oppenheimer from an outperform to a perform. And, you know, I'm not sure it's going to be performing based on this chart. I see that the PMO is turned down, getting ready for a sell signal. And you can see price has some work to do again to get down to some, I would say, more strong support than what we're looking at for the 50-day EMA. I mean, certainly it could hold the 50, but I would be looking for it to come back down based on the momentum change here, that shift, possible sell signal. I think it just has to work its way down a little bit, and then maybe we'll see it make its way back up. But again, I think this one has some work to do to the downside as well. All right, next downgrade, Goldman Sachs. Morgan Stanley downgraded Goldman Sachs today from overweight to equal weight. And this is the daily chart. And as you can see, no real support levels to be found here on the daily chart. I do want to point out on the daily chart, however, that the PMO is extraordinarily oversold right now. Typically, Goldman Sachs moves between -2 and +2 as far as the PMO. So seeing a -3, more than a -3 reading, that tells me that we are very oversold. And, you know, that's when we start to look for that turn back up to the upside. But where would that support level be? We'd have to look at the weekly chart to find that. And 190, I suppose you could call that support here based on these, what looks like shoulders from a head and shoulders that was back here in 2015. The big problem is, of course, we lost this support level from 2017. So the next area, like I say, you could make a case maybe for 190, but I would be looking closer to the 170, 160 area where we had some lows back here, kind of matches up right here, the 170 level with tops back there. But look at the PMO twice now, 3 times it's turned down below its signal line, below the 0 line. So I wouldn't be holding out too much hope right now for Goldman Sachs. Financials are getting hit especially hard. So I would stay away from that area of the market if you're on the buy side. All right, Lowe's was also downgraded today by Stifel from a buy to a hold. And looking at this downgrade, I can certainly see why. It's been on quite a slide. The PMO is in oversold territory. We got a bit of a fake out here, buy signal on the top of this rally. And now we've been heading back down. And the bottom right here on the PMO is going to be lower than the previous. So look at the OBV just heading straight down. And of course, relative strength on the scooter just falling quite a bit here. Where's the next level of support? Well, we're sitting right in the middle of a previous trading zone. So I would be looking down here at 80 as a downside target. Okay, that was all of the upgrades and downgrades that I had planned on covering, but here are the list of those. There were a few other upgrades. Bed Bath & Beyond was upgraded. Edison was upgraded. And some other downgrades. Well, one other downgrade I didn't cover was Credit Suisse. Look at the Goldman Sachs chart and you'll see pretty much the same thing on the Credit Suisse chart. All right, let's go ahead and bring in Mr. Schnell.
Hey there.
All right. Are you ready to show us a golden setup or something? Is that what I heard?
So I think it's always important to start out my conversation that I don't mind being different when it comes to offensive philosophy, because Tom and Erin trade a lot of breakouts. And I'm living in Canada. Our stock market's the same level it was at 10 years ago. So I trade some of the stuff from the bottom up. I try to use strong stocks, but I want to see them start to break out. So I'm going to cover that off today and get into some of those different trading styles. So the first thing I wanted to cover was back in August, we did a meeting at ChartCon 2018. It was fabulous. Tom and Erin were both there. And I kicked off the ChartCon presentations with a Goldman Sachs chart. And this was kind of the setup that we were looking at on that weekend. And so what we had was Goldman Sachs was in a bit of a downtrend and was turning up. And one of the things I said was, you know, I don't really like to use the daily chart as much. And so I just briefly want to show you the difference between all of these setups. And one of the main things that I like to look for, we're going to talk a little bit about relative strength here, is this purple shaded area is my relative strength. At the top I have the scooter ranking, and you can see Goldman's currently in the 10% level. But looking at this big head and shoulders topping structure on Goldman, we've just broken down now. But there was a lot of clues here, and we had talked about these clues on the actual show, or on the ChartCon presentation. And what I was mentioning was that the PPO was now dipping below 0, and be very, very careful because once you get a dip below 0, this is an important place to watch. So I'm just going to bring up the slide that I used. I think it was this one. Let me just check. Yeah. So what I mentioned was back in 2015, it had dipped below 0 and has a strong likelihood of marking the last rally. Beware of the rollover. And sure enough, we had a small rally up, got up to just above the 40-week moving average, and it plummeted. So anytime you start to see a setup below 0 and a flip up, you want to watch for how high that gets. Now, it could get above, back above the 0 level. The right shoulder here could go back above the top here in price. You don't know, but it's basically telling you to be cautious that you're probably heading into a final rally. So if you're still owning it, you better figure out a way that you want to get out of it. And then you had a PPO downtrend here, and when that started to break, that was a good time to start to look for positive divergence. And here now we have this same setup where we have going below 0, rolling over, and now breaking through support. And this downtrend in the PPO is really important to me, and I mentioned it on the in the ChartCon presentation. So what I suggested was year-long trend lines matter, and when you get the opportunity to put a big trend line on these charts and you see a lowering of momentum, that's a pretty critical thing to pay attention to. And it worked out really well with Goldman Sachs. You could have done this trend line down here and it would have faked you in and came back down and given you a second low. Drawing the trend line here, this is a particularly important setup to me. So when you can draw a trend line and you get your PPO just pulling back just under it, and the next turn up would actually get you through that line, that is typically a beautiful place to get on board. And so, if we look at Goldman Sachs, this was a pretty nice upward thrust to be a part of. And obviously, if we could have caught all of that, we'd be pretty happy. It was interesting to hear Erin talk about somebody downgrading Goldman Sachs now after a $100 move lower. It's a little bit late, but the point that I would make on these charts is when you get this opportunity. So in August, we had this setup coming up and just rolling over right where you'd expect it to at the PPO trend line. And again, the full stochastic couldn't make it all the way back up. So all of this was telling you to be cautious. If we look through, I think it's this final chart. Let me just grab it here. Yeah, so go back to the daily. So at that point in time, we have a negative setup on the weekly. The chart comes up and it's rallying, and this is your buy signal. And what we're talking about here is this doesn't look very good because the PPO, we were just getting there. So even on the daily, it kind of looks okay, and this is an okay trade because your weekly full stochastic starts to come in. And don't get me wrong, this is $10 or $15, so it's a trade. But the big issue is you have a negative PPO. So now if we just unwind the tape here and show you what happened since then, of course, here we are, and Goldman wobbled through August and then kind of unloaded, I would say. And even in September, pulled back. Then in October, was falling down. There was a brief rally at the end of October in almost everything, and Goldman participated in that and tries to give you the impression that it wants to go higher. But again, your weekly chart is telling you to stay defensive. And so this chart, much like Erin said, probably wouldn't be a big buyer of it, but even some sort of a bounce up is probably expected. The real question is, the chart is broken, and until the momentum changes, I think you want to be aware of that. So if I just go back and take this same chart, and I just want to show you a Canadian stock right now, and I've traded it from the long side. But what you see here is the PPO, actually the Canadian one is a little bit better. So let me just show you, because that's the one I'm trading in Canadian dollars. The PPO is just breaking here. And so when you get these breakouts, so this is a year-long trend line or 11 months, this is a nice place to get on board. And you can see the stock is starting to work its way higher. And you've got positive divergence here, so you've got a higher low and you've got a lower low in price. So it's this sort of setup that as the market comes back to us and we get the opportunity to start to look for these higher lows on the right-hand side, this is an important place to get involved. So I would encourage you to look at the weekly PPO. I think it's one of the more helpful signals as to what's going on. And again, this, you didn't want to get involved here because you were gone negative. It rallies up, and now it gives you a higher low in here. And this is a much better place to get involved than, say, this peak here. So when we go look at different stocks, and I'm just going to X out of here. When we go look at different stocks today, what I want to talk about specifically is getting into the right setup on a weekly chart. So I'm going to get into the gold trade, and the reason I want to talk specifically about gold is there's a whole bunch of setups going on, and I think we should be aware of them. So first of all, I'm going to start with the US dollar. And one of the things to notice, this chart here, let me just hide gold. I put it in there, but I can just dim the light switch on it. And the way I did that was I just hit change the opacity from 1 to 0, and then it makes it invisible. So this red line on this chart, going back from 1979 to current, is at 97.5. And last week, or a couple weeks ago, we saw gold actually rally up to 97.4 was its close, 97.5 is its high. The point I want to make is it's a really, really, really important level for the US dollar. And for going all the way back before the big breakout, it was support, then the US dollar surged, and this was the oil embargo and a whole bunch of things going on in here. And then we came back down, and then the US dollar waffled around here, but became a ceiling for almost 10 years around this 97.5 level. When we finally broke above it, this was the internet boom, obviously, and the US market soared and came back down, and it kind of gut checked itself right around these lows and then continued to go below, and we spent a long time down here. On this higher low is when commodities all rolled over in 2011, 2012. They all started to bail, and when we turn back on gold, you'll see it's pretty much marking the top, and it's been retracting since. But what we have now, if we just stood back and look at it from a big picture, is we have gold kind of 3 drives to a high, trying to get through this 100 level, and briefly did it, then pulled back and made a lower low, a lower high, a lower low, and now it's made a higher high. But the big thing for us is we're right back at this 97.5, and I think it's a critical place to be aware of, because what we got in 2016 was when this didn't hold, this little move in the US dollar right here, this very, what looks like tiny move, caused a 150% rally in the gold miners. So this is a really interesting setup for us. And this is Pring's special K indicator, which is a longer term indicator. And you can read more about that in Chart School. But what you see here is we're coming right up to this big trend line. And one of the things Martin likes to talk about on his special K is that it does a great job of making defined trend lines of places you should be aware of. And when this bounce right here in 2014 and the dollar took off on a big vertical surge, and now we have it exactly the opposite, just barely above 0 and a down sloping trend line. This is on a big, big, big scale. This is a critical place on this chart. And you can see going back, it bounced off these levels. It was resistance in here in 05, 06. It was support in here all the way through 2011, 13, 14. So just being aware that we're getting up against a major trend line, and it's a down sloping trend line on the US dollar. If this was going to roll over, this would be one of the best calls ever. And the reason is because when you broke this trend line on the US dollar up here, this is really when commodities started to rally. And they had a great year. And of course, in the middle of 2008, in June of 2008, is when oil made its final top. So let's go turn on gold again. And what I want to mention here is that you can see as the US dollar topped out, gold started to turn up. And this was a pretty important place on the chart to be aware of. And all of a sudden, it was a nice big 10-year run. A couple of other things happened. So keep this 2002 date in mind, because I'm going to show you some relative strength charts on a macro picture in the relative strength segment at the end of the show. And I think it'll give you some clues as to why we're particularly interested right now. So anyway, we have this big setup on gold here, and you can just see the last 3 or 4 years, basically we haven't gone anywhere. We've been winding sideways. Now I've been trading some of these rallies, and as long as you're in strong stocks, you can actually make some money in there. But we're sitting right here at a very important support point. And if gold can start to turn up here, this is a pretty meaningful place on the chart. So that's the big picture on the US dollar. Let me just go in a little bit closer. And this is the daily chart for the US dollar. And what I want to show on this is we've got this trend line right here, and it's being tested over and over, and we've got this 96 level. the PPO, sorry, I've used the MACD on this one, but it's rolled over right kind of where we might have expected it to, and it's drifting lower. We aren't out of the woods yet, but I think the macro trade for gold is setting up, suggesting that this is getting weaker. And the reason, most people are like, well, the U.S. economy is doing so well. And I will fully agree that the U.S. economy is doing better than most economies in the world. One of the biggest things that's also going on, though, is the rate of debt is going up in a lot of countries. And just on a fiscal basis right now, the debt for the last 2 years, so 2019, the annual deficit will be a full 50% higher than 2017. So we're going to go to $1 trillion. And the issue with all of that is eventually it devalues your currency. And so that's one of the reasons that I'm watching this a little bit closer. So we don't have a... we have the setup where everything is starting to make you think that the US dollar wants to go higher with this big basing structure. But in general, it's kind of, we would expect a surge as it breaks above this trend line here. And we're just kind of waffling for the last month or so. Anyway, so that's one of the reasons I like it. Now we're going to get into some actual gold charts. And this is gold versus, so GLD versus the S&P SPY. And what you see here is this little break on this downward trend. So this is a 3-year trend line, and it broke. And during this little move here, well, gold started to outperform the S&P 500. That was the kickoff. And what happened here was, well, first of all, gold went from, down at this, GLD went from 100 to 130. So a nice 30% move. But the gold miners made this 150% move in 6 months. So the question is the setup here now? And I'm just going to zoom in on the right-hand side of this chart here, and we're going to talk about that. So I'm just taking the chart down to the last 2 years so we can see what's going on. And what we see here is GLD has been making higher highs and higher lows for the last 4 months. We've recently broken out above this big downsloping relative strength trend line, and GDX has just broken a little 5-month downtrend here, and we still have the major downtrend to break. So it's whatever, call it 10% higher from here. So the setup is starting to get interesting. One of the particular reasons I like it is it broke out, pulled back, and then started to break out again in relative strength. And that tells me that it's not just kind of running up and then falling down like a lot of these other ones. It, immediately tried to break out, pulled back, and it looks like it wants to go again. So I'm more interested in this particular setup. And as if gold can get going, and it's still an if, again, we're watching the US dollar very closely, but this whole setup is starting to work. So here's GDX. And what we see on GDX, which is the gold miners ETF, is, this price action is starting to break above previous resistance. So it pulled above, came back down, tested the lows one more time, and now it looks like it's ready to keep going higher. I mentioned on November 3rd, this looks like it was starting to curl up. Well, it actually did one more wave lower, but some of the stronger stocks have not taken that wave lower. So now over the next 10 minutes or so, I just want to talk specifically about gold stocks. And what I recommend people do is have a chart list specifically for the type of stocks you trade. So Tom and Erin are constantly looking at biotech stocks and high-tech stocks and artificial intelligence and whatever else it might be, the FANG stocks. You can put them all in chart lists together. So I specifically recommend having a gold chart list if you wanted to trade gold stocks. And what we're going to do from this chart list is we're going to put numbers on here to help control the sort order, because I don't really need to look through all of the garbage. I really want to look at what the strong charts are. So the last time I was in here, I set up these numbers on the front. But the idea being, you can just take those numbers off, resort it as to current data, and get it. So the point I want to make is, here's Barrick Gold. And the chart on Barrick is looking pretty attractive, I think. And for the world's largest gold miner, you would expect, based on the fact gold hasn't done anything, this chart is already up 50% from the September lows. So something's going on in the world's largest gold miner. And I agree, they did a merger, some other stuff like that. But, we can go down to Franco, Nevada. These are some really nice charts, and they're just starting to get going. So I think there's big opportunity here, and that's the reason that I want to spend the next few minutes just covering off the gold trade. So first of all, how to get rid of these numbers once you put them on here so that you can just kind of run through them. And the way to do that is to edit the list, and then you click on that box, or down at the bottom of the command here, you can hit select all. And one of the options over here is to remove numbers from, and anything that's checked, it'll remove the numbers. So that's good, and it's going to take it back to just the characters. Great, so we've got that set up. But the problem is when we're in edit mode, there is no way to sort on what we want to sort on. So do we want to sort on most recent price change? Do we want to sort on scooter ranking? What do we want to sort on? And for me, I like to sort on the scooter ranking because that's typically what gives me the strongest stuff. Now, there's also another way to do this, and we can just add a column here. And the column I want to add is volume. And if they don't have a scooter ranking, I want to sort it by volume. So hopefully that makes sense to everybody. We have a lot of stocks that trade in Canada or on the Amex that don't have a scooter ranking, and some of those are gold. So rather than throwing them out, we'll sort on the volume, and then I forgot to show the scooter ranking. So let's just turn that on. And then the next thing we want to do is click on the scooter ranking. So it'll sort it by volume, it'll sort it by scooter. And when we get to the end of the scooters, it'll sort it by volume. Okay. So this is just a way of trying to put the strongest stocks together near the top. I'm thinking strong stocks have interest and weak stocks don't. So we want to stay away from the stuff that's not really valuable. Now, at the bottom of this list, and again, I'm going to use the function key to just take us down. There's a button down here at the bottom of the table, and you just hit number in sorted order. And what that's going to do is it's going to put numbers in front of each one of these, and it's going to start with a 4-digit number. And when we do that, what you'll see at the very top of the chart list is it puts the strongest ones first and puts the number in here based on the scooter ranking or whatever sort order we picked. So when we look through these charts now, it's going to show us the strongest stocks first. And I think if you're a Canadian trader or a US trader, you could turn on whether or not, as an example, we could add this column for you, which universe, and here's the TSX, and we could put all of the TSX first or last, and then look at everything else. So the mids and the large and the small caps would be US-based ones. So anyway, the idea being just to put the strong stocks first, and now we're going to go look at them just in a 10 per page mode. And the idea here is not to sell you on the gold mining stocks. The idea is to get you set up so that when gold mining stocks perform, you can join the party. So here's Largo Resources. I like to use weekly charts, but here's the 5-year, and you can see the relative strength is starting to change here. So I would be cautious on Largo Resources, and they actually mine for something called vanadium, V-A-N-A-D-I-U-M, and it's pretty rare in the world, but needless to say, it's been on a big run from $1.50 to $4.50. It's up 300% in 6 months. That's not really the chart I want to buy. I want to buy something getting ready to move, and we're going to use our PPO to help us with that. So, I think I've got different time frames in here. So I'm going to just click on this chart, and I'm going to scroll to the bottom, and what it says is apply this style to all. And by doing that, it's going to change all of the charts in this entire list to have the same setup. So it's going to have the scooter ranking, the relative strength, full stochastics, the actual price, volume, and my PPO. Okay, so let's go back and look at them in summary. order. And again, what we want to, oh, whoops, I should have done that differently. There we go. What we want to do is just be able to scroll through these very quickly. So this chart, the PPO has been pulling back nicely, and it looks like it's just getting ready to try and thrust away here. So I would, it's not my favorite chart, mostly because it's already run up quite a bit. I want to try and find something more like the Barrick Golds or whatever. And this West Dome, this has been a really strong performer. You can see it move from $1.80 to $4.18. So it's trying to base in here. Maybe it turns up, maybe it doesn't. A little more different. But here's Northern Dynasty Minerals. And 2 years ago, this thing went from 50 cents to 4.50. So I don't know, 900% or something. And recently, it's just started to move. Now, this is a copper miner, and I'm starting to see some of the industrial copper stocks start to move. So I think there might be something there. Here's Oceana Gold, and it's starting to break above new 52-week highs. The PPO is above zero, just gently pulling back. And if it can break out of this, then I'd want to get involved, pretty much right here, right now. And any sort of a breakout from these big 52-week bases, that's typically a good place. And the other thing that it's showing us is when your full stochastic bounces around 50 and then turns back up, these can make for very good moves in the stock. So here's a good example where it kept bouncing above 50. And these are just nice places to keep adding to positions. And then here's the Silver Bear ETF. And this one actually is starting to do exactly the opposite. It's rolling over. And if it was to continue down here, that would be more bearish. So I would, just because we're looking for upside breakouts, I'm not really interested in bear positioning. So here's SSRM, Silver Standard Resources, and there's a US ticker symbol for this same stock. But, if we just look at $14 here, this thing is just pushing to fresh new 52-week highs. While this trade is just getting set up, the PPO just made a higher low below zero, and it's just starting to get going. This is as good as it gets. This is the kind of movie I want to talk about. And then in some of these other stocks, these are just starting to get going. This thing has been split multiple times downwards. We're not even going to go there. But here's Oceana Gold, the US ticker symbol. Already covered it off. But here's Barrick Resources breaking out to 9-month highs right now, just getting above this 1778 level. That's a 9-month high on the world's largest gold miner. The PPO is just moving above zero. When that happens, that's a pretty great place to get involved. So this is the kind of setup that I think is really good. Now, if we look at the relative strength trend line, what do we see? We see a big 2-year downtrend, and clearly we've broken that downtrend now, and we're starting to head higher. And the relative strength is 6 or 8 months that it's been outperforming. Looking up here, the scooter ranking is just starting to get going, and it spent about a month up here. So while everything else in the market has been pulling back, this is starting to go. And Barrick Gold's US ticker symbol is ABX. So if I was to draw a long-term PPO trend line here, just kind of across these highs, and it's just starting to break out, that's the kind of setup I want to look for. Okay, so to give you an idea, I think all of these gold stocks are getting ready to rock. In our last minute here, I've got Franco-Nevada just starting to turn up. It lists on the US as FNV. This is a 4 or 5 month breakout. Scooter ranking just going above 75, full stochastic above. And it's just getting ready to break this down sloping trend line on the PPO. It couldn't be a better setup. Gold. The ticker symbol gold is starting to work as well. So hopefully I've given you some ideas here of how I look at stocks. I used the Goldman Sachs example at the beginning to say when you start to get these PPOs turning up, and we have all of the conditions ripe on the US dollar to make this happen. So with that, I'm going to turn it back over to Tom and Erin, and we'll continue on.
All right, sounds good. Why don't we bring up that poll? You talked a lot about gold there and the setup, and so let's talk a little bit about the poll. I know you threw me under the bus there a little bit.
Hey, we can always do that to each other, so that's good.
Yeah.
Hey,
Yep.
the good news is a quarter of the people are with you, Boley.
Yeah. Well, I think what Greg was showing is kind of what I've talked about in the past, and that is, we're starting to see a little bit of a turn up in gold relative to the S&P 500, but we've seen this before. And I think, honestly, Greg, I agree with you. I think that the key to all of this is the U.S. dollar, and I still see an uptrend in the dollar. If that rolls over and we start moving lower on the dollar, obviously that would open up the door for this setup for sure. I still believe the dollar goes higher. I still think that we're in a series of lower highs and lower lows in terms of the relative performance of gold versus the S&P. So I'm not ready to get on board this trade yet. I need to see more. I think if it does turn and the dollar does roll over, I think there will be plenty of opportunity to the upside. I just need to see a little bit more relative strength in gold over an extended period of time. And I think you showed that one period back in 2016 where gold did really well, but that has really been the exception since 2011. We haven't had many periods where gold has gone 6 months outperforming the S&P 500. So I don't know. I'm not there yet. I hear you.
And you might be after we do the relative strength at the end of the show, because I've got some other charts that hint that this might be the time to get on board commodities. So we'll go there later.
Okay. Erin, did you weigh in here on the poll?
I did, and I said not yet. I need to see a little bit more going on there on my gold chart. In fact, I've got to look at it so I can speak to it in my mind here for you guys. Yeah, we got the little breakout above that consolidation, from September, in September, that zone. We managed to get above that, but I want to see it get to 1240 or above. My PMO is starting to slow down again as we've gotten now into that area. As far as the dollar goes, the correlation has been on the positive side since, end of October, the 50-day correlation. So to me, that's, we're decoupled from the dollar a little bit. So I think gold could still rise. So I think you could be bullish on both at this point.
Well, historically, the two they're not decoupled for long.
Right.
They don't stay decoupled. There is.
This is the longest I've seen in a while when I look at my chart. I'll have to go back and look in history at it. But for the year, this is, the first time, end of October is the first time we entered into that positive setup. And it's still, the 50-day correlation is 0.41. So, I mean, that's a pretty high positive correlation right now. But we'll see. I'm watching it. Yeah. But that's how I kind of can give you my opinion that I am bullish on both, if that makes sense.
Yeah, I think the tendency to, anytime you get a really weak market, there's a lot of fear in the market. Gold tends to be a safe haven. Also, the dollar, because it's been so strong, I think you're seeing folks still buying the dollar. So I think in the short term, that's a kind of a, I don't know. I think it's going to continue maybe in the very near term, but I think essentially or eventually we're going to get a break in one or the other. Either the dollar comes down and Greg is absolutely spot on and we see gold take off, or that dollar continues its move to the upside, in which case I just can't see gold outperforming the S&P 500 if that's the direction of the dollar. So I think there's still a lot to be said. And I know Greg, you said you've got other relative charts to show later in the show. So we can go back through this again. You know which one of these poll answers I picked?
No.
Not until Boley says it's a good idea.
That's the one. Hey, I didn't put these up. I didn't come up with today's polls. Or anybody out there saying, "Wow, I can't believe Tom put his own, put his own answer up there." That's not me. I didn't do that. Greg.
No, this was Grego. Yeah, I did it.
Grego.
Guilty as charged. So.
Yeah. Anyhow, great presentation, Greg. I know a lot of folks do enjoy trading commodities, gold in particular. So definitely a very good argument on the gold side.
Thanks.
Okay, Erin, 10 in 10. What do we got?
All right, let's go ahead and I'm going to pull up that chart for you of the RRG. We had a pretty good amount of requests, I thought. Let's see here. Let's go right there. All right. Tandem diabetes, obviously causing some issues with everybody now, moving into the center just because it's such an outlier. So I'm just going to come in a little bit more here. There's another one, of course, the gold miners. It's now leading in a big way, ABX. So that, I think it gives some credence to what you were saying, Greg. But when we look at sectors, as far as the requests, consumer discretionary seems to be the winner today. So let's go ahead and get started, though. Let's see. Abbott Labs was the first one in healthcare.
All right, let's take a look at Abbott. Okay, first thing I would say is you are in the pharmas, and you look at the pharma chart. It's been very strong, got a nice up move. We topped in October. So far, we went back, put in a reaction low. So I think the trading range has been established on the pharmas. But the overall trend here remains higher. So if we do sideways consolidate, the more likely direction after the consolidation would be a breakout. I do think that Abbott has been one of the stronger stocks in the pharmas. There are others out there that have been stronger, but this one's hanging in there pretty well. You got a group that's moving up, and since rising earlier in 2018, we've kind of been holding our own with ABT. So I think that looks good. You got a clear outperformer versus the S&P, and pharmas have been outperforming the S&P 500. So this is a setup that I think looks pretty good, especially in a market like this. Pharmas are somewhat defensive. So I think that it does present the possibility for gains without nearly the risk that you have with many of the high-flying technology stocks and so forth if the market does roll over and we do turn into a bear market. So I like Abbott. I would be watching the two horizontal lines here between about 65 and 67. That marks recent lows, both on a closing and intraday basis. And then if you just look back to May and connect these lows, you can see right now we're testing a trend line. So you could even potentially, if you wanted to follow the trend line, you could be looking maybe at a close at 68, although I would give it down to the recent lows. I think Abbott goes higher. I think this one looks pretty good. It's a relative outperformer in a number of ways. So I'm bullish Abbott.
All right. The most popular, and this could be an interesting little play to see what you think, is Bristol Myers. So another pharmaceutical, BMY.
All right, well, here you're going to see a big difference. And the reason why I would like Abbott a whole lot better. This also, as you mentioned, is a pharma. Had the big gap down, heavy volume in October, came back up, just recently tested gap resistance and rolled back over. But that's only one of the problems I see with the stock. So here is that failure at gap resistance. I would be out of the stock. I just think there are other stocks that look a lot better, including Abbott. But if you look, here's the pharma chart again that I showed earlier. But now look and see what you have in terms of relative strength within the pharmas. Bristol Myers has been horrible. It was a really, really bad October on a relative basis. That's where we had the selling leading up to that big gap down. Very heavy volume. That looks like distribution to me. So I would be a seller on this move to the upside, and I'd be looking for somewhere else within pharmas like Abbott to potentially get involved. I know Johnson & Johnson just made a pretty good breakout as well, J&J, watching that 146 resistance level. I know that we did clear that recently, so that would be another possibility as well.
All right, let's see. How about our only real estate sector request? Realty Income Corp.
Yeah, and I think, again, with a really highly volatile market and thinking that, hey, potentially this could be a bear market, I think a lot of the defensive areas make sense to trade, at least in the near term. Let the market get its feet under it if you're looking at it from a more bullish perspective. And while volatility is running high and fear is running high, anxiety is running high, these are the types of stocks I think that make a lot more sense. Now, Realty Income has had a huge move up last 5 or 6 weeks. It's going to be very overbought. I think I would have to wait on a pullback. But as I look at it, I mean, you can see its peers have been doing pretty well, nearing a breakout, and Realty Income is one of the stronger stocks. And as you look over the last couple of months, you're going to see all of these lines moving up from left to right, which tells me that you do have one of the stronger stocks in some of the strongest areas, or one of the strongest areas in the market as well. So I think as long as the rising 20-day moving average continues to hold and that relative strength remains good, I'm perfectly fine with a stock like Realty Income.
All right. This is our only technology request today, so I figured we must do it. KLAC.
All right, semis had a pretty good day yesterday. Didn't see KLA individually, but let's take a look at KLAC. Yeah, it rebounded as well. There's definitely some overhead resistance. Here's the semi group moving lower. And I definitely think that there is risk involved in trading these semis. The relative strength in KLA, because semis are near their low, and you can see KLA has actually bounced, KLA 10 core. You can see that the relative strength has been pretty good. But when you look at it longer term, it's just kind of been going along for the ride, and the ride has not been a very good one. So I would just say this. I think on the downside, you had some pretty good support that came in. I'm going to say right in the 96 to about 98 area. That's where we bounced throughout most of 2018. And then when we lost that level, you can see the volume accelerate. And each time we've gone back up, we've been struggling in this area now. If we could get a big breakout and get through 98 and you start seeing 99, 100, the volume picks up, we got a different ball game. Until then, I'd be cautious with KLAC as we're right now in this overhead resistance area.
Okay. Let's see. Let's do the next one, Cigna. I'm loving their commercials lately with all the TV doctors. I don't know if you're seeing those where you're at.
I don't know. I wouldn't notice. Most of the time, commercials get tuned out.
Time to go get another beer.
Yeah, that and commercials and CNBC both get the same treatment. CI, yeah, I like the stock. I mean, the pullback here to the 50-day, I don't have my PPO, but I'm assuming that off of this uptrend, we probably had a negative divergence on the most recent high. I think the pullback to the 50 here is pretty strong. I like the reversing candle we're seeing today. Overall, you can see that the DJUS HP, which is the healthcare products or healthcare providers, I should say, index has been strong, just recently breaking out to a new high. This hasn't been one of the better performers, but it is starting to show a lot of relative strength the last 2 or 3 months. And so I think overall you got a pretty good stock here as long as price support doesn't give way. And I'm going to draw that price support line in down just around the 200 level. If we break below 200, I'd have to reevaluate. Otherwise, I like it.
Okay. Let's see. Next one, our only industrial from the defense industry, L3, LLL.
All right. Well, the group has been very, very weak, as you can see, the last 6-8 weeks, like the overall market. And you can see L3 Technologies also pretty weak. The question is, I mean, I see a bear flag straight down move, and now we're just kind of, got this little flag action out to the side. But this is a pretty significant price support level that we are now upon. So I want to see what happens here. But 180 is a big level on the stock going forward. We saw during the late April, early May weakness in the stock. We came down, we held 180. All of that huge selling that we just saw in October got down to about 180, 181. It held, we bounced. And you can see also on the rally, we went right back up and tested an area of overhead resistance. So I think we're in a trading range right now in this flag pattern. We're sitting kind of in the middle of it. I don't think there's anything here to do with L3. And I think overall the pattern is weak. I wouldn't really be excited unless we saw a false breakdown where we come back up and close above 180 after a pretty significant breakdown intraday, or get back up through 195. Until I see one of those two things, I would probably just sit on the sidelines.
Okay. Let's see, next one in the publishing industry, New Media Investment, NEWM.
All right. Overall, again, the group has been weak. I mean, we weren't too bad just a couple of weeks ago in the overall space in the publishing. But, with the overall market dropping, this is another one of those areas that really took a big hit. But you can see here back in earlier November when we were near the high, this stock was nowhere near its earlier high. So on a relative basis, you got a very weak performer. So again, it's one of these situations. It couldn't hold on to support at about 1370. Let me just put that line in there so you can visualize that. But right there, you can see the low all the way back in February, tested again at the end of October. Pretty weak bounce. and then right back down below. Now, if there's one positive here, it's that when we take out these lows right here and break to new lows, the volume was fairly light. So if we can get back up through the 1370 level, especially back up above that 20-day, maybe we'll begin to see some relative strength. But given the relative weakness in the recent breakdown, even though the market has not broken down, I think I'd be on the sidelines just watching for now.
Okay. Let's see, next one up, H&R Block, HRB.
All right, false breakout, and there you have a dark cloud cover candle. So it was up trying to challenge the overhead resistance. So if I draw that line in right where we had gapped down from, right here, huge gap down. Took us about 4 or 5 months, but the gap's been filled. And then we put in a reversing candle off of an uptrend, come back. I think that there's 2 levels to the downside I would be watching. First is going to be this breakout that we saw around 2720. And then just above that is your rising 20-day moving average. If this truly is an uptrend that's going to continue, then I would expect somewhere between 2720 and 2750 to see a rally. Now, we did get as low as 2765 earlier today, and we're bouncing back off of it, currently up near 28. But I think that as long as we hold on HRB, H&R Block above, say, 2720, I'm going to stay bullish. But given the overall market, if we lose that level, I would quickly be out.
Okay. Our final one, consumer discretionary, Ethan Allen, ETH.
All right, we got a poor group and you got a poor stock. Actually, on a relative basis, the group has been so bad that this performance actually ranks pretty well versus the group, which is kind of surprising. Perhaps because we are trading above where we were in October while the group has continued to move lower. But still, there's a lot of work to do here with this stock. I think taking a look at the chart and knowing that the overall group has been so weak, I think maybe the thing I would follow is the downtrend, which it's trying to make a breakout here, but not a whole lot of volume to support it. So volume today, only 138,000. We're past the halfway point of the day. This is going to be a light volume day. This is not the kind of volume I want to see with this particular breakout. So I'm wondering if it's going to fail. You see a lot of these tails over here in October and November between about 20 and 20 and a half. Today, right now, trading at 2034. I'm not seeing enough yet to get excited. I'd like to see the volume pick up this afternoon. Unless that happens, I'd be a seller.
All right, that is it. That completes 10 and 10. And I know we have some really interesting stuff to talk about. So just want to quickly let you know that if you go to the blogs tab, click on the Market Watchers live blog, and our live chart list link is at the top. And that's where you can find all of these charts that Tom just annotated. All right, time for our final market update. Let's see what's going on. Certainly a better day than we've been experiencing lately. All right. Looking at our candle glance here, we can see that all of the markets pretty much are up right now. The big leader, though, right now is the TSX, currently up over 2% right now. The other big winner, I would say, as far as the big indexes, Russell 2000, it's up 1.88% currently. And the NASDAQ actually is making a comeback here at 1.64% on its gain currently. Notice the treasury yields are up here, currently reading 3.076%. UUP is down slightly, and we can see that gold, big gap up, had a pullback here in the morning before lunch, but it does seem to be heading back up toward the intraday highs that we saw earlier. TLT bonds are lower on the day, trying to bring back some of those losses, pare them back a little bit, but TLT is down 33 cents, currently at 114.72, and oil is up. USO currently up over 3.8%, looking at a current reading of $11.70 for USO. And that's all I have for our final market update. What you got for us, Tom? I'm going to get my charts ready for relative strength.
All right. Well, again, we are seeing the market performing pretty well so far today. I just want to again point out, if you weren't here earlier, There was some gap support on the S&P 500 at about that 2680 area from all the way back here. We had filled it. Looked like we were going to try and turn up off of that level, and then we gapped down yesterday. Now, maybe because we're hitting that those October lows, maybe in the short term this is a chance for the market to rally. But I really think we've got to get through that 20-hour EMA. When we get into downtrends, you can see that serves as pretty good resistance. Uptrends, for the most part, same thing, although this we did pull back to the top of gap support there. But for the most part, I think the 20-period EMA tends to be a pretty good trend following moving average. So, yeah, we're up today. It feels good relative to what we've been seeing, but we still got some work to do here on the S&P 500. So watch that 20-hour and that 2680 level. I think those are going to be two key levels of resistance here in the near term. Okay, it is time to move into relative strength. And so what we're going to do here is Erin and Greg and I are each going to take about 4 or 5 minutes and just talk to you about whatever we're seeing in terms of relative strength. So Erin, I'm going to pass it to you first, and then Greg will follow, and then I'll wrap up the segment in a bit.
All righty. I've decided, since it's Pick on Tom Bowley Day, that I'm going to use your words a little bit against you today.
That's fine.
All right. So what I was looking at was, as far as relative strength, is right off, I wanted to talk about sector rotation. And let me see if I've got my chart here where I can see it. Okay, yeah, let me get it so to where you can see what I want to talk about. So the first thing I wanted to show was the DP sector scoreboard. And obviously you note that the only ones with intermediate term trend model buy signals are the defensive sectors. Everybody else is in a neutral and long-term trend model. We see a little bit more, a little less of the defensive sectors, with XLY still on a buy in the long term and technology still on a buy. But all of the others, as far as the aggressive sectors go, are all in neutral. So you usually talk about how you will get worried when rallies are coming off the back of these defensive sectors. So what I thought I would take a look at is this little rally that we had at the end of October here on the S&P. So I'm going to kind of zero in on that particular rally, because it is a rally within what could be the beginning of a bear market. So I wanted to point out what I'm seeing as far as the strength there. So when I look at the relative rotation graph for that period of time, the 5 weeks before and ending on November 9th, clearly you can see which sectors are leading and doing well. Of course, the defensive sectors.
Erin, I'm still seeing your decision point sector scoreboard.
Thank you. Let's try it this way. How's that?
Much better.
All right, good. All right, so I wanted to take in fact, I'm going to show it to you really quick again. I wanted to look at this particular rally in a little bit more closely. So obviously, relative strength-wise, we're seeing the defensive sectors leading, and especially during those 5 weeks before November 9th, which was that little bit of a rally here. You can see right in there. So what I wanted to look at after this was the perf chart during that particular time of that rally. So from about mid-October to the beginning of November. And the leading sectors were clearly staples, real estate, materials is also sometimes considered a defensive sector. Utilities was doing quite well relatively in comparison to the aggressive sectors. Now, granted, we had a little bit of move on the discretionary side, but in general, that rally came off the back of a lot of defensive sectors. And that concerns me. And please, if you haven't yet, read my Decision Point article from yesterday evening. I'm just going to give myself a little plug here. I looked at the PMO and how the preludes to bear markets and what that looks like with the PMO. And I'm seeing a lot of similarities that have me concerned. So what I wanted to do is, I started looking at the bear markets we had previously and a lot of the similarities in the PMO to what we're seeing now. So go ahead and read that. So to me, seeing those defensive sectors leading on the rallies, granted, some of the others did, rise during that period of time, but performance-wise, it really came off those defensive sectors. And that's all I have, Tom. So I don't know who wants to go next, but yeah, do take a look at my blog. I think it had some really interesting information in it as far as the historical perspective before bear markets.
Okay, Greg, what you got?
Okay, let me just grab the screen from Erin. Okay, so what I wanted to cover off just from relative strength. So one of the big things that happened, this is the TSX here, and basically the TSX is unchanged in the last 10 years. So we're at 15,000, and we were back there when oil hit its highs in 2008. So a full 10 years of nothing. So when we look at relative strength, this is the Toronto Stock Exchange compared to the S&P 500. And you can see this big, beautiful upsloping channel. And on the day this broke, I wrote, is something changing here? Who knew that it would lead to a 10-year slide or an 8-year slide? And basically, this has been commodities underperformance. Now, there have been two periods that commodities have done okay since then, really. This was oil falling apart here in 2014. And then here's 2016. And coming off the lows in early 2016, commodities actually had a pretty good year. So when I look down here, and you can see we're approaching the S&P trend line right now, but the TSX versus the NASDAQ, we broke that in 2016, and it was actually slightly earlier than the break on the S&P 500. And we've now broken the TSX compared to the NASDAQ, which is quite interesting to see that, that we're performing better than the NASDAQ. And then the second time that we saw that was against the Russell. Same period, early in 2016, it kind of marked a shift. Now, one of the things about the Russell in the US is it has a lot of commodity stocks in it. So it's a brief outperformance. But anyway, you can see Canada started to outperform the Russell as well. So just standing back, big macro picture, when the TSX started to outperform back in the 2002 period, and you remember that on the US dollar, this was Canada's outperformance for 10 years. And then this is 2011 when the US dollar made its final bottom, Canada underperformed. So if Canada is going to start outperforming on a commodity market, one of the big things to look for just in general is the Toronto Stock Exchange starting to outperform the S&P 500, and is the Australian stock market starting to outperform the S&P 500. Those two things could be very big clues. Now, obviously with the pullback in oil, it's been ugly, and just $20 worth or so on West Texas. But the important thing to keep in mind here is that commodities don't go to zero. And we've fallen relatively significantly, right? Just down to 52-week lows right now. And that 52-week low doesn't mean the lows are in. But I will point out that some of the oil stocks are starting to base a little bit on their area, but I wouldn't get involved in them until the relative strength starts to show up. And what we want to look for, let's just take ConocoPhillips or something. What we see here is this uptrend in relative strength, and all of a sudden this is breaking. And if this starts to resume its uptrend, I want to get back on board when that happens. Now, the companies like ConocoPhillips that do refining and that kind of stuff, we're holding up better. If we go look at something like Chesapeake, you know, these charts just with 5 years of data get a little washed out. But you know, we have a downsloping relative strength, and usually the times you want to get involved in a stock are when you break this relative strength downtrend. The scooter was breaking, everything kind of kicked up here. And, you know, whether commodities, one thing about them is you must trade them. You can't buy and hold them like a MasterCard or a Visa. You gotta move with them. Oil's not going to $1,000 like MasterCard or Google. So what you find is the stock will rally, and you need to play a part in that. Now, here's $3 to $6 in a couple of months. So when they move, it's awesome. When they go against you, it's awesome. The big thing to remember in commodity trading is relative strength is very important. And you'll see on many stocks that's starting to become, it's almost like a light switch. When things start to outperform on relative strength, very clear. And Dave Keller, one of the things he always likes to talk about is at Fidelity, they constantly search every day for new relative strength 3-month highs and new relative strength 12-month highs. That's just what they do. And that's how key it is it's like they're one of their number one searches that they will do. So all that to say, I like the way gold is setting up right now. And if I just put Barrick Gold up here, and I'm not trying to pump it, I'm just saying one of the things we've seen here is a big downtrend in relative strength, and that trend line is starting to break. And it's that kind of thing that I want to look for. The Scooter ranking also helps tell you that kind of thing, but that's why I sorted on Scooter. But it's this break in relative strength from a downtrend. That's a clue. And now here we're starting to make new, 9-month relative strength breakout. The stock is starting to set up. The 10-week is moving above the 40-week. The 40-week is basing. It's pretty much flat right now. And any sort of upthrust on this would kind of get you going. So it's that kind of thing that I like to look for, relative strength outperformance. And I chart on my dailies, on my weeklies, on everything I do, I have relative strength. So I would encourage you to add that chart to your chart pack. Anyway, with that, Tom, I'll flip it over to you.
Okay, sounds good. All right. What I wanted to do is just kind of take a little bit of a trip down memory lane. I mean, every bear market is different. I mean, it'd be nice if every single bear market did exactly the same thing as the prior one. We'd all be able to call the bear market in advance and be out of the market. But they all do set up a little bit differently. If you remember the 2000 to 2002 bear market, it was all of the dot-com stocks. Technology got crushed. You go to 2007 to 2009, it was the financials. It was the financial system meltdown. There were some bear markets, 2000 to 2002, you barely saw much movement to the downside in small caps, which tend to get hit pretty hard during bear markets, but they didn't in that one. So everyone is different. What I try to do is look at I view the market as a big puzzle with lots of different pieces. And with price being the biggest piece in the puzzle, what is going on with price? You can't dispute price. I mean, if the price is going down and it just continues to go down, you got lower lows, lower highs, you can come up with all kinds of things taking place in the market. But the bottom line is prices continue to go lower. So with that in mind, I'm just going to go back quickly through these last two bear markets. And in 2000, here you can see the S&P 500 making its final high back in August. I think the top may have been actually in March, but I think we went back and kind of tested it in August. But what you're going to see is that technology relative to the S&P was already in a move down. The XLY versus XLP, which is consumer discretionary versus consumer staples, was falling apart at the time that the S&P on the surface looked like it was fine. And what I tend to do is I use these ratios and so forth as just clues, just pieces of the puzzle, not the puzzle itself, but pieces of the puzzle. And when utilities are outperforming and consumer staples are outperforming relative to the S&P 500, when we're going into that final move to the upside, yeah, that is a concern of mine, because if the market is looking out and it likes what it sees, then what we should be doing, or what we should be seeing, is money rotating into aggressive areas. We didn't see that in 2000 at the final high, and we moved lower off of that. Let's fast forward 2007 through 2009 bear market, the final high. Now, again, technology didn't do too badly at the very end. Actually, it was leading the market when it put in that final high in October of 2007. But look at the XLY versus XLP. Why in the world would the market be moving up into October 2007, still, looking very strong in terms of price action, and have money rotating so significantly? This isn't a slight pullback. This is a very, very significant rotation into consumer staples relative to consumer discretionary. And it wasn't coming off of a huge move. I mean, the last year had been pretty flat prior to that decline. So you can't even argue, relative profit taking. There was just nothing really good to glean from this move down. I mean, we were talking about moving down to multi-year lows on the XLY, XLP, just as the S&P was putting in that higher high. XLU versus the S&P started to outperform on a relative basis. Same goes with staples relative to the S&P, and voila, we started seeing breakdowns in price. To me, that confirmed what we were seeing in the market. Now, last chart, if we go into where we are right now, we've had the huge move on the S&P, the first initial pullback. Now, remember, this is a weekly chart. We didn't have lower lows in March. This was a weekly close. So we did have a lower weekly close. We did not have a lower daily close in this period. But this established, in my opinion, a major support level at 25.82. In the next push to the upside, to the final, if this is the final push in September, the XLK versus the S&P was still rallying. The consumer discretionary versus staples had flatlined, which could be viewed maybe somewhat negatively, but it came after a massive rally in consumer discretionary stocks versus staples. Now, yes, over the past pullback, we've definitely seen technology losing its luster. That normally happens during pullbacks. We didn't see it so much in January, but most of the time when you get pullbacks in the market, money rotates away from aggressive areas. We have since seen that as well, although I could make a little bit of a case for the XLY, given the fact that it outperformed by so much. In fact, I was on record back a few months ago saying I wouldn't be surprised to see the XLY, XLP drop at some point because we had such tremendous outperformance by consumer discretionary. And then, yes, utilities are starting to move up. Staples are moving up relative to the S&P. No doubt about that. What I have a problem with at this point, saying that this, in order to come up with a conclusion that we're in a bear market, is we have not lost price support on the S&P. And consolidation can take on many, many forms. I'm not going to be convinced that we have seen a peak until we lose that 25.82 S&P 500 support. So those were the relative charts, relative strength charts that I look at and that I use. I could have gone into a lot more. I wanted to make it somewhat quick to be able to go through two bear markets and all the consolidation that we're seeing here. But I will say that what we're seeing right now looks very similar to me to what we saw back in 2016. And that did not turn out to be a bear market. I was concerned in early 2016, and I'm concerned right now, but I haven't seen the confirmation yet. So I'm going to stick with correction for now.
All right. So if we do see that breakdown, then you're probably going to be on the bear market side. I know I'm kind of waiting for that as well to kind of confirm what I'm thinking as far as a bear market. But yeah, I don't know.
I'm not waiting for the cement truck to show up. When the PPO on the S&P is below zero, I want out. Yeah. And we're below zero. Yeah, so I'm expecting a rally here, but I am very far from wanting to stay active on the aggressive side of the market for anything other than bear market rallies.
I will say, Greg, that the PPO below the center line is a necessary ingredient for a bear market. There's no doubt about it. We have just crossed it. But 2015 and 2016, we also crossed it during a correction.
But yeah, and we went down 20% to the bottom in 2016. So we didn't quite make 20, but it was far enough that I think everybody was really hurt by their portfolio.
But the low in 2016 simply went down and tested the 2014, 2015 lows, which is what we could be doing here with that January low. Just saying.
Okay.
Yeah,
and
for me, that
we got to wrap
PPO on
I
the
know, we got to wrap it up.
Over.
Read my blog article. I think I even have something about the 2016 thing in there. So take a look at it.
Sounds good. All right.
Thanks, everybody.
Greg, thanks for stopping by and joining us today. Always fun. Want to thank all of you for being with us today. Please remember to complete the survey as you exit. As a quick reminder, Market Watchers Live airs 5 days a week, Mondays through Fridays from noon to 1:30 p.m. Eastern Standard Time. Have a great Wednesday afternoon, everybody. Have a great Thanksgiving. Enjoy your long weekend. We will not be back here on Friday. Take care. Happy trading. Be safe. See you Monday.